Quick note before we begin. This is an educational breakdown, not investment advice. Now let's look at Wednesday, August 19th, 2026. On this specific afternoon, the Indian market split into two entirely contradictory financial realities. To understand why, we have to start with the secondary market, which was busy wrapping up a grim milestone, its seventh consecutive day of decline. The exhaustion was obvious. The Nifty 50 finished at 24,078, and the Sensex dropped to 76,909, a slow, heavy staircase downward. The damage was actually broader. On the BSE, 1,814 shares advanced, completely overwhelmed by nearly 2,500 declining stocks. The pressure wasn't coming from domestic issues. Crude oil prices were climbing, which directly widens India's import bill and pressures the currency. At the same time, a sharp rise in global bond yields was pulling foreign capital away from emerging markets. Looking at the broad market indices, everything was functioning logically. The numbers accurately reflected a tough macroeconomic reality and genuine capital exhaustion. Then there was the other half of the day. Over in the primary market, a logistics technology company named Shiprocket made its public debut. Shiprocket is a company that still loses money. Despite that reality, it listed at 131 rupees on the NSE, a 35% premium over its 97 rupee issue price. To get that jump, you need an avalanche of demand. The 1,600 crore rupee offer was oversubscribed 99 times. Remember, this explosion of capital happened on the exact same afternoon the broader market was actively bleeding out for the seventh day in a row. How does an exhausted market, entirely unable to put together a single positive session for a week, suddenly find the conviction to reprice a loss-making IPO upward by a third? This divergence represents a documented structural feature of how primary and secondary markets function. The first mechanism at work is divergent flows. Large secondary index moves are dictated by massive institutional allocations. These are funds responding heavily to macro variables like oil, yields, and currency. Primary market demand, particularly in the retail and non-institutional buckets, is driven almost entirely by the expectation of quick listing gains. These two distinct pools of participants operate on completely different timelines with entirely separate financial incentives. Capital moves through isolated channels, which allows money to flow in opposite directions on the exact same afternoon. The second mechanism to understand is engineered scarcity. Unlike the free-flowing secondary market, an IPO is a deliberately limited, fixed allocation of shares. Look at the subscription data. Qualified institutional buyers bid 122 times over their allotment, and retail investors bid 46 times over the available supply. When nearly 100 times the available stock bids for a fixed allocation, the resulting math completely breaks away from traditional valuation models. That 131 rupee listing isn't a considered, sober verdict on the company's long-term worth. It is simply the clearing price for an engineered supply shortage. The gray market premium, or GMP, highlights a different kind of mechanic. Unlisted shares were trading around 130 rupees right before the 131 rupee debut, providing a mirror image of the final listing price. But the GMP isn't a financial model or a rigorous institutional valuation. It is simply an unregulated sentiment thermometer. It creates a self-fulfilling loop. The gray market and the listing auction are populated by the exact same participants, reading the exact same oversubscription data. When everyone looks at the same high demand and bids up the gray market, that gray market price then justifies higher bids on listing day. It is an echo chamber. A massive gray market premium doesn't tell you the underlying business is financially sound. It only proves the crowd is highly confident the crowd will keep buying. If we zoom out from August 19th, we can see what this specific pattern implies historically across market cycles. A hot, explosive primary market existing right alongside a tired secondary market with negative breadth is a recognizable late-cycle signature. It tells us that risk appetite hasn't disappeared, but it has concentrated into the narrow, lottery-like corners of the market, where the payoff is quick and visible. Meanwhile, conviction in the broad market has thinned out. Now, this observation is a diagnosis, not a forecast. Markets can sustain this late-cycle configuration for long stretches of time, or they can break it very quickly. You can see this caution in how analysts treated the Shiprocket debut. Even those with a bullish view recommended partial profit booking, treating the listing pop as a short-term event to be actively managed rather than a valuation to be trusted 6 months out. Ultimately, the index measures where large, long-term capital is willing to sit. The IPO measures where retail demand will chase short-term scarcity. When those two realities diverge this sharply, the most useful question isn't which market is right, it's which market you are actually participating in.